The topic for this video is Module 4, Investment Instruments, Chapter 9, Debt Securities for the CFA Institute Investment Foundations Program. So here we are in Module 4, Investment Instruments, starting Chapter 9, Debt Securities. For this chapter, there are 13 learning outcome statements, and there are 69 questions in the learning ecosystem. The learning outcome statement for this chapter are: Learning outcome statement A, identify issuers of debt securities. B, describe features of debt securities. C, describe seniority ranking of debt securities when default occurs. D, describe types of bonds. E, describe bonds with embedded provisions. F, describe securitization and asset-backed securities. G, define current yield. H, describe the discounted cash flow approach to valuing debt securities. I, describe a bond's yield to maturity. J, explain the relationship between a bond's price and its yield to maturity. K, define yield curve. L, explain risks of investing in debt securities. And M, define a credit spread. Learning outcome statement A is identify issuers of debt securities. So companies and governments raise external capital to finance their operations. Both companies and governments may raise capital by borrowing funds. So as the illustration on the slide and in the text shows, in exchange for the use of the borrowed money, the borrowing company or the government promises to pay interest and to repay the borrowed money in the future. Okay? As discussed in Quantitative Concepts chapter, from the borrower's perspective, paying interest is the cost of having access to money that the borrower would not otherwise have. For the lender, receiving interest is compensation for opportunity cost and risk. The lender's opportunity cost is the cost of not having the loan cash to invest, spend, or hold. That is the cost of giving up other opportunities to use the cash. The various risks associated with lending affect the interest rate demanded by lenders. Learning outcome statement B is describe features of debt securities. Debt securities represent a contractual obligation of the issuer to the holder of the debt security. A bond is governed by a legal contract between the bond issuer and the bond holders. A typical bond includes the following three features. Number 1 is the par value. Number 2 is the coupon rate. And number 3 is the maturity date. Okay, so starting here with the par value, the par or principal value is the amount that will be paid by the issuer to the bondholders at maturity to retire the bonds. The coupon rate is the promised interest rate on the bond. The term coupon rate is used because historically bonds were printed with coupons attached. There was one coupon for each date, and each coupon indicated the amount owed, the coupon payment. Bondholders cut off the coupons of the bond and submitted them to the issuer for payment. The use of the term coupon rate also helps us prevent confusion between the promised interest rate on the bond and the interest rate on the market. Coupon payments are linked to the bond's par value and the bond's coupon rate. The annual interest owed to the bondholders is calculated by multiplying the bond's coupon rate by its par value. For example, if a bond's coupon rate is 6% and the par value is £100, the coupon payment would be £6. So it's important to understand that the coupon payment never changes, okay? The cash payment never changes, but interest rates do change. Prices on bonds do change. So, yields on bonds do change, but the coupon payments never change, okay? That cash payment is always the same. Now, coupon payments, many bonds, such as government bonds issued by the US or UK government, make coupon payments on a semi-annual basis. Therefore, the amount of interest is halved and paid as two coupon payments payable every 6 months. So in the previous example, the bondholders would receive two coupon payments of £3. Now, coupon payments are sometimes paid annually, quarterly, or monthly as well. Debt securities are offered over a wide range of maturities, and although it is rare for new bonds to have a maturity longer than 30 years, okay? So the life of the bond ends on its maturity date, and the issuer is not responsible for any further payments after that date, assuming that all promised payments have been made. Okay? So the maturity date is the date when the bond matures, and that's when the principal is paid back to the bondholders. Continuing with features of debt securities. So as we said, a bond is governed by a legal contract between the bond issuer and the bondholders. The legal contract is sometimes referred to as the bond indenture or offering circular. Okay, so that term bond indenture is fairly important to understand, and that's the legal contract. Now, other features may be included in the bond contract. So these are features within the bond contract to make it more attractive to bondholders. For instance, to protect bondholders' interests, it is common for the bond contract to contain covenants. Okay, so that's another term to be familiar with. And covenants are legal agreements that describe actions the issuer must perform or is prohibited from performing. And so it's important to understand that covenants are within the legal contract, which is the bond indenture. Okay, and a bond may also give the bondholders the right but not the obligation to take certain actions. Okay. Later on, that's language that's very common to the investment industry. When we're talking about options, options give you the right but not the obligation to take certain actions. Okay, so we're going to see that in a little bit more detail in some further learning outcome statements. And bonds may also contain features that make them more attractive to the issuer. Again, these include giving the issuer the right but not the obligation to take certain actions, and we'll explain that in more detail later in the video. Learning outcome statement C is describe seniority ranking of debt securities when default occurs. Okay, so the bond contract gives bondholders the right to take legal action if the issuer fails to make the promised payments or fails to satisfy other terms specified in the contract. If the bondholder fails to make the promised payments, which is referred to as default, the debt holders typically have legal recourse to recover the promised payments. In the event that the company is liquidated, assets are distributed following a priority of claims or seniority ranking, which can affect the amount the investor receives upon liquidation. So first we're going to look at secured debt. And secured debt are securities with certain specific assets pledged as collateral. Okay, so when a borrower issues secured debt security, it pledges certain specific assets as collateral, such as plant, property, and equipment to the bondholders. Therefore, in the event of a default, the bondholders are legally entitled to take possession of the pledged assets. Next, we look at unsecured debt, and unsecured debt securities are not backed by collateral. Consequently, bondholders will typically demand a higher coupon rate on unsecured debt securities than on debt securities. A bond contract may also specify that an unsecured bond has a lower priority in the event of default than other unsecured bonds called subordinated debt, which may also be ranked according to priority from senior to junior. So you can see here, this is something that you need to be memorize for the exam, is that in terms of the rankings, the highest level is secured debt, which is assets pledged as collateral. If there's no collateral, if the debt is not backed by any collateral, then it's unsecured debt, and within that there's three levels here: senior unsecured debt, senior subordinated debt, and then junior subordinated debt. So very likely on the test there'll be an exam question regarding the levels of seniority, and you can see that senior unsecured debt is higher than senior subordinated debt. So those are the keywords that you need to pick up on. And I might do some type of Q card SD subordinated debt, and then I know I've got unsecured debt, senior unsecured debt, senior subordinated debt, and then junior subordinated debt. I'm going to make some type of flashcard that just summarize the four levels. Okay, so that's very important to understand that senior subordinated debt is higher than junior subordinated debt, but lower than senior unsecured debt in terms of the seniority rankings. So a quick practice question from the learning ecosystem to check our understanding, and this is considered to be an expert question. And the question is, when a bond issuer defaults, the contract that allows bondholders to take legal action is the A, covenant, B, bond indenture, or C, subordination agreement. Okay, the correct answer is B. The bond indenture is the contract that provides bondholders the right to take legal action if the issuer fails to make the promised payment or fails to satisfy other terms specified within the bond indenture. So this is a question of getting some of the language and terminology correct, okay? A is incorrect. A lot of people might have thought that when an issuer defaults, the contract that allows bondholders to take legal action is the covenant, but that's not correct. Covenants describe actions a bond issuer must perform, and they're contained within the bond indenture. So in the event that a company is liquidated, assets are distributed following a priority of claims or seniority ranking, which we saw. And not all debt holders have the same priority of claim. Bond borrowers often issue debt securities that differ with respect to seniority ranking. And so then when a bond issuer defaults, the contract that allows bondholders to take legal action is called the bond indenture. I'm just going to take a minute here to point out a study tip. So here I am in the learning ecosystem. We just had an expert question that was referring to bond indenture. So, if you got it wrong, you want to go back to the text and find out where you made your mistake. So I've highlighted here the correct paragraph. A bond is governed by a legal contract between the bond issuer and the bond holders. The legal contract is sometimes referred to as the bond indenture or offering circular. So I found it. But one of the issues that I find within the learning ecosystem, there's not really a search functionality for an individual word. If I was to type in the word indenture here, you can see that no results match it. So then the next thing that I often recommend is you go into the glossary. So I'm into the glossary now, which is a PDF document, free on the website. And I recommended that you download all the chapters and the glossary. And if I type in here indenture, and try to see if I can find it. No. So bond indenture is not included in the glossary. So finally, I'm in the PDF document for chapter 9. And again, I recommended that you download all the chapters. And as I said, sometimes the PDFs are useful because if I go into the PDF for the chapter and I type in indenture and I click on next, aha, there it is. It comes up right away. I can highlight it. So that's one of the powers of having the PDFs for the text, is that if you get a question wrong and you're looking for a specific term, if you go in and use the search functionality in the PDF, it brought up the paragraph for me right away. Okay, so that's just one of the quick tip that I wanted to point out to you, the difference between using only the learning ecosystem versus also having the PDF open when you're reading through a chapter. If there's a word that you can't find, I find it's a lot easier to find it within the PDF. Okay, so that's why when I'm doing my studying, I have the learning ecosystem open. I also have the PDF document open. I also have the binder with my text. I like to have paper copies, and I have the glossary as well. So as I've always mentioned, English test, subject in this case, debt securities, a term called bond indenture. Got a question wrong, go back to find it. How can I find it most quickly? Sometimes by using not only the learning ecosystem, but also the PDF, okay? Learning outcome statement D is describe types of bonds. So bonds in general can be classified by issuer type, by the type of market that they trade in, and by the coupon rate. So looking here at issuer, bonds can be issued by companies, and they're referred to as corporate bonds. Bonds issued by central governments are sovereign or government bonds. So it's important to understand that governments like municipal governments or provinces can also issue bonds, but when we're talking about sovereign bonds, they're the bonds that are issued by the central governments, okay? With regards to the market, the primary market is the market in which new securities are issued and sold to the investors for the first time. In the secondary market, investors trade with other investors. So stocks and bonds are, when they're initially issued for the first time, it's in the primary market. And then when they start to trade and exchange hands between other investors, that's called the secondary market. In terms of coupon rates, bonds are often categorized by their coupon rates: fixed rate bonds, floating rate bonds, and zero coupon bonds. And with regards to those coupon rates, we're going to look at that in more detail in learning outcome statements coming up later in the video, okay? Now, it's important to understand a little bit of other terminology with regards to maturities, okay? Debt securities with maturities of less than 1 year may be referred to as T-bills. So if we're talking about U.S. government treasury bills or T-bills, or Canadian treasury bills, the maturity is less than a year, so we call them bills, all right? If the maturity of a debt security is 1 to 10 years, we're going to call that notes, okay? So that's a little bit of terminology. And longer than 10 years, we call them bonds, okay? So just a quick terminology with regards to bills, notes, and bonds. Okay, on this slide, we're looking at the example that's in the text with regards to fixed rate bonds. And fixed rate bonds or fixed income securities are the main type of debt security issued by companies and governments. So a fixed rate bond, number one, has a finite life. It ends on the bond's maturity date. So we can see here, we're looking at the example for Walt Disney, which issued some bonds in August 2011. So you can see par value, 750 million, 750 million, and 350 million. That's 1,850 million that they in terms of par value that they issued on August 2011. Okay, so the features that we're looking at is, number one, the bonds have a finite life that ends on the bond's maturity date. So they issued 5 years, and again, these are called notes because that's the key thing to realize is that the 5 year and the 10 year as well, because it's 1 to 10 year, the 10 year are also called notes. And then over 10 years, they're called bonds, okay? So Walt Disney issued 5 year notes, 10 year notes, and 30 year bonds on the same date. So this was 2011, in August 2011. So the 5 year notes, the maturity date was 16th of August 2016. The 10 year notes, the maturity date is 16th of August 2021. And the 30 year bonds, the maturity date is 2041, okay? So the second thing to note is that the coupon rate does not change, okay? That cash payment does not change. And you can see that the coupon rate annually on the 5 year note was 1.35%, and the rate on the 10 year note was 2.75%, and on the 30 year bonds, the annual coupon rate is 4.375%. So we can see in terms of the longer the time, in terms of the interest rate or the coupon rate, it's upward sloping, okay? And that has to do with the longer the time that the maturity is coming, the more opportunity cost, okay? So in general, on average, the longer the time to maturity, the higher the rate's going to be, okay? So if we just bring up the calculator and we look at this coupon rate, so the par value of one bond is 1,000. That's the par value of one bond. The number of bonds issued was 750,000. So 750,000 bonds times par value 1,000 gives us our 750 million. So when we look at that annual coupon rate, it's against the par value of the bond. So we're going to start with the par value, $1,000 par value times 0.0135. And so annually, our coupon payment is going on the par value of 1,000 is going to be $13.50. But if they're paid semi-annually, we're going to divide by 2, and you can see therefore our semi-annual coupon payment per bond is $6.75. So now we're moving on to look at floating rate bonds. In the previous slide, when we were looking at those Walt Disney bonds, the coupon payment is never going to change. But floating rate bonds, sometimes referred to as variable rate bonds or floaters, are essentially identical to fixed rate bonds, except that the coupon rate on floating rate bonds changes over time. The coupon rate of a floating rate bond is usually linked to a reference rate. The London Interbank Offered Rate, this is LIBOR. LIBOR stands for London Interbank Offered Rate, is widely used as a reference rate, okay? So the floating rate is calculated by making an adjustment to the reference rate to reflect the riskiness or creditworthiness of the issuer at the time of issue. The floating rate is equal to the reference rate plus a percentage that depends on the borrower's, issuer's creditworthiness and the bond's features. The percentage paid over the reference rate is called the spread and usually remains constant over the life of the bond. Okay, so you can see that's an important point to point out. We're going to look at this 9-month, £2 million loan, and the coupon payment is LIBOR, which is the reference rate, plus 140 basis points. Okay, that spread over the reference rate does not change. That's an important thing to understand, and it's a quarterly reset. Now, this is bringing up a new terminology, basis points. It's what we use in fixed income. 100 basis points equals 1%, okay? So 100 basis points equals 0.01, okay? So 140 basis points is going to equal 0.014, okay? That's the spread, and it's constant, okay? The reference rate does change over time. So, of course, LIBOR does change over time. That's changes of level of the interest rates in the economy. So in bond markets, the practice, again, is to refer to percentages in terms of basis points. Therefore, rather than stating a floating rate as LIBOR plus 0.75%, the floating rate would be stated as LIBOR plus 75 basis points, okay? So interest rates, basis points. 100 basis points equals 1% equals 0.01. So 75 basis points would equal 0.75%. It would be 0.0075, okay? So that's an important thing to understand. A floating rate bond's coupon rate will change or reset at each payment date, typically every quarter. So this is very important to understand. Floating rate coupon payments are paid in arrears. That is, at the end of the period on the basis of the level of the interest rates set at the beginning of the period. So you can see here, when we're looking at the 30th of June payment on this loan, the rate that we're using is coming from the beginning of the period. So we've got March, April, May, June. So when the coupon payment here is using the rate from March, okay? So you can see 120 basis, it was LIBOR, which was 1.2%, plus 140 basis points. So we're dividing by 4 because it's a quarterly payment, and that's how we come up with the coupon payment. So let's just bring up the calculator very quickly to look at it. So these coupon payments are based on LIBOR plus 140 basis points. So the LIBOR at March, at the beginning of the period, was 120 basis points. So that's 0.012 plus the 140 basis points, the spread, which never changes. The LIBOR changes, but the spread doesn't change. So plus 0.014. We're going to, so 2.6% divided by 4 because it's a quarterly payment, then multiply by the principal, £2 million, and you can see that our payment is £13,000. Okay, so that's how we made the calculation. Now, if we move to the next payment here on the 30th of September, we can see that it's a LIBOR, which is now 100 basis points, 1%, plus that spread that never changes, divided by 4 times the 2 million, and we get to the £12 million for the payment. So you can see that the coupon payment went down. Why? Because LIBOR went down from 1.2% to 1%, or 120 basis points down to 100 basis points. Then the LIBOR went back up, so you can see that the payment is always based on the previous, at the rate, the LIBOR at the beginning of the period. So we'll do a quick practice question here to check our understanding. This is from the Learning Ecosystem, and it was classified at the expert level. So a company issues a $1 million floating rate note on 30th of June, maturing in 6 months with a coupon rate equal to 3-month LIBOR plus 80 basis points. Based on the following table, which LIBOR rate will be used to calculate the coupon payment on 30 September? Is it A, 0.85%, B, 1%, or C, 1.15%? Okay, the correct answer is A, 0.85%, okay? So the quarterly interest rate will be reset at LIBOR plus a spread each quarter in arrears. That means behind. So an annual rate is quoted, although payments are made quarterly. To arrive at the next quarterly payment, LIBOR of 0.85% plus a spread of 0.8% are summed and divided by 4 quarters. And the rate is set at the beginning of the quarter for the next payment date. That's the important thing to understand. So here I've recreated the table, part of the table from the previous slide, just to show you. And again, you don't need to do the calculations. It's a nice to know, not need to know, but the more you understand, the better. So you can see here that the LIBOR rate on the 30th of June was the 85 basis points, and the coupon payment is LIBOR plus 80 basis points. So that's the spread. The spread never changes. The 80 basis points, LIBOR does change. So when we're looking at this payment here on the 30th of September, even though the LIBOR rate was 1%, to calculate the coupon payment for 30th of September, we're using the LIBOR rate at 30th June in arrears, or at the beginning of the period. So it was 85 basis points, which is 0.0085. Remember, 100 basis points equals 1%. So 0.01. So 85 basis points is 0.0085. Plus this, so that was the LIBOR, plus the spread of 80 basis points. And you can see here again, although payments are made quarterly, to arrive at the quarterly payment, we take the annual rates and we divide by 4. So we divide by 4, we multiply by the million, and the coupon payment is 4,125. Again, nice to know, not need to know, but it just follows the exact part of the table, exact same as the previous slide. Therefore, I don't think this is an expert question, but once you've worked your way through it, I think you'll find that it's not too difficult. Okay, so how could that be changed? Well, they give you different rates and different dates. They could say, for example, what is the rate that's used for the 31st of December coupon payment? And again, the rate that you would use would be for the rate at the beginning of the period, which would be the 30th of September. So keep your eyes open for a question like that on the exam. Not too difficult. Once you understand, I don't think it's quite an expert question. So now we're moving on to look at inflation-linked bonds. So an inflation-linked bond is a particular type of a floating rate bond. So the previous slides and practice question was looking at a floating rate bond where we had a base rate like LIBOR plus a spread, so the coupon payment was changing. But now when we look at an inflation-linked bond, it's also a floating rate bond, but you need to be very careful because it contains a provision that adjusts the bond's par value for inflation and thus protects the investor from inflation. So it doesn't adjust the coupon, it adjusts the par value. Changes to the par value reduce the effect of inflation on the investor's purchasing power from bond cash flows. Remember, the principal is paid back on maturity. So if there's been inflation during the life of the bond, what happens is the principal value is changed, the par value is changed for inflation, and that protects the investor from inflation. So index-linked bond, it's a particular type of floating rate bond, but it's not the coupon payment that's being changed, it's the par value that's being changed. So for most inflation-linked bonds, the par value, not the coupon rate, is adjusted to reflect the changes in inflation, which is usually measured via a consumer price index. So we saw a little bit, now you can see how things are coming together. Why we studied in the economics section about the consumer price index, it's important because that is applied to inflation-linked bonds, okay? So because the inflation protection offered by inflation-linked bonds, the coupon rate on an inflation-linked bond is lower than the coupon rate on a similar fixed rate bond. Okay, so that's the other important point when you're talking about comparing or contrasting, because the inflation inflation-linked bonds have inflation protection. The coupon rate on an inflation-linked bond is going to be lower than the coupon rate on a similar fixed rate bond. Important point to pick up on. Yeah, obviously that could be tested. And indeed, this is a practice question from the learning ecosystem classified to be expert. It says, which of the following characteristics most likely remains unchanged during the life of an inflation-linked bond? A, the par value, B, the coupon rate, or C, the coupon payments? So the correct answer is B, the coupon rate usually remains unchanged. The par value of the bond, not the coupon rate, is adjusted at each payment date to reflect changes in inflation, usually measured by a consumer price index. Okay, so again, just copied over some information from the table. For most inflation-linked bonds, the par value, not the coupon rate of the bond, is adjusted at each payment date to reflect changes in inflation. So you can see that the coupon payments will change because the par value is changing and the par value is changing. So it has to be B. Okay, so again, you can see how this question could be changed to you know, what changes. It's the par value, and therefore the coupon payments will also change, but the coupon rate does not change. So now we're moving on to zero coupon bonds, okay? So as with fixed rate and floating rate bonds, zero coupon bonds have a finite life that ends on the bond's maturity date. Zero coupon bonds do not offer periodic interest payments during the life of the bond. They only offer a single payment equal to the bond's par value that is paid on the bond's maturity date. Zero coupon bonds are issued at a discount to the bond's par value. That is, at an issue price that is lower than the par value. The difference between the issued price and the par value received at maturity represents the investment returns earned by the bondholder over the life of the zero coupon bond. Many debt securities issued with maturities of 1 year or less are issued as zero coupon debt securities. For example, Treasury bills issued by the U.S. government are issued as zero coupon securities. Companies and governments sometimes issue zero coupon bonds that have maturities of longer than 1 year. Because of the risk involved when the only payment is the payment at maturity, investors are reluctant to buy zero coupon bonds with long terms to maturity. The expected return would have to be very high, and issuers are reluctant to pay such a high cost for borrowing. Also, if the buyer of a zero coupon bond decides to sell it prior to maturity, its price could be very different because of changes in interest rates in the market and or changes in the issuer's creditworthiness. So here we're looking at example, it's from example 4 in the text, okay? And the investor buys a 20-year, 1,000 euro zero coupon bond for 268.31 euros. This will give the bond a 6.8% annual return. Now, again, you don't need to, you're not required to do the calculations, but I just want to show you, we learned in quantitative concepts the concept of present value. Present value equals the future value divided by 1 plus r, the interest rate to the power of n. And so now we're seeing an application of this, calculating the present value, that is the price of a zero coupon bond. Because there's no interest payments, we can simply use this formula. Again, this is a nice to know, not need to know, but I think it's going to show you that it's fairly easy to understand the example in the text. So if we look at the future value or face value, par value, is 1,000 euros, and we're going to divide by the interest rate, 6.8%, so 1 plus 0.068 to the power of 20. So that's 1,000 euros divided by 3.72756. And you can see I'm using a slightly different rounding because I'm using 5 decimals. You can see that the price or present value of the bond is 268.27 euros. Now, the example in the text is showing that 1 year later, interest rates have gone up and are now at 8%. So we calculate the price of this zero coupon bond 1 year later. So you can see 1,000 euros divided by 1.08 to the power of 19. So it's going to be 1,000 euros divided by 4.3157. And you can see that the price has gone down considerably to 231.71 euros. Okay. So again, just in summary on the zero coupon bonds, the price is just equal to the par value divided by 1 plus the market interest rate to the power of n. the number of years in this case until maturity. Not that difficult to understand, and a nice little application. And so in quant, we learned present value, future value. Now we're applying it to calculate the price of a zero coupon bond. Again, not required to do the calculation, but I think you'll find that it helps you understand the change in the price. And number two, to give you confidence that something that you learned in quantitative concepts is fairly easy to apply now that we're looking at the chapter on bonds. And in this case, present value calculations, the formula, how it applies to calculating the price of a zero coupon bond. So just very quickly, here's the example that I was referring to in the text. It was example 4, the zero coupon bond. So you could see here that 20 years, present value equals future value divided by 1 plus R. To the end, the required rate was 6.8%. So that was just a present value calculation. And then to illustrate the sensitivity, we're looking at 1 year later where the required rate has gone up. So as we said, that's again an important concept. As the interest rate goes up, the present value goes down, and that's just a functionality of the algebra. Present value equals future value divided by 1 plus R to the n. Increase R, you're going to decrease the present value. So you can see here 1 year later, so n equals 19 and I or R equals 8%. We do the present value calculation, and you can see that the price dropped from 268 to 231.71. So I just wanted to show you, you might be reading through the text and saying, well, where did those numbers come from? It's just a simple present value calculation, easy. So a quick summary of some of the things that we looked at for learning outcome statement B, which is describing features of debt security. So number one, we looked at bond features, par value, coupon, and maturity. A typical debt security is characterized by 3 features: the par value, the coupon rate, and the maturity date. Second, we looked at fixed rate coupons. So that was the Walt Disney bonds that we looked at, the example. And fixed rate bonds are the most common bonds and offer fixed coupon payments based on interest or coupon rate that does not change over time. So that coupon payment doesn't change, and that payment is the coupon rate times the par value. Then we looked at floating rate coupons, and floating rate type bonds typically offer coupon payments based on a reference rate, that's LIBOR, that changes over time, plus the fixed spread, okay? And important to understand that we learned something about basis points, that we refer to, 100 basis points equals 1%, okay, which equals 0.01. So therefore 75 basis points would equal 0.75%, which would be 0.0075, okay? So that's just, a little bit of terminology and nomenclature. Number 4, we looked at zero coupon bonds. The only cash flow offered by a zero coupon bond is a single payment equal to the bond's par value to be paid on the bond's maturity date. Some other things: covenants are legal agreements that describe actions the issuer must perform or is prohibited from performing to protect bondholders. Remember, we find covenants within the bond indenture, which is the contract agreement. We also looked at secured or unsecured. Debt securities are classified as either secured debt securities, so they're secured by collateral, or unsecured debt securities not secured by collateral. And again, for the unsecured, we had to remember that 3 levels of seniority. And in the event that a company is liquidated, assets are distributed following a priority of claims or a seniority ranking. And the other thing we might add here is that we also looked at inflation-linked bonds. And the important thing to understand with the inflation-linked bonds, that they are a type of a floating rate bond, but the coupon rate doesn't change. It's the par value that changes, okay? So at each time the coupon payment is made. So because the par value is changing, the cash value will change, but it's the par value that's changing, okay? The coupon rate remains unchanged. So that's a nice little summary of some of the things that we looked at with regards to Learning Outcome Statement B. Quite a bit of information was contained in that Learning Outcome Statement. Nice little review here. So now we're moving on to Learning Outcome Statement E, which is describe bonds with embedded provisions, okay? So first of all, we're going to look at callable bonds. And a callable bond provides the issuer with the right to buy back So to retire or call the bond from bondholders. So that's a right to the issuer, not an obligation, okay? So they can call the bond back, they can buy it back from the bondholders prior to maturity at a pre-specified price referred to as the call price. The call price typically represents the par value of the bond plus an amount referred to as the call premium, okay? In general, bond issuers choose to include a call provision so that if interest rates fall after a bond has been issued, they can call the bond and issue new bonds at a lower interest rate. For example, consider a company that issues a 10-year fixed-rate callable bonds that are callable starting 3 years after issuance. Suppose that 3 years after the bonds are issued, interest rates are much lower. The call provision allows the company to buy back the bonds, presumably using proceeds from the issuance of new bonds at a lower interest rate. It is important to note that the call provision is a right of the issuer and not the bondholder. The call provision is an advantage to the issuer and a disadvantage to the bondholder. Thus, a call provision generally results in a higher coupon rate to compensate the bondholders for the risk, referred to as call risk, of having the bond retired early. So for most callable bonds, the bond issuer cannot exercise the call provision until a few years after issuance. The pre-specified call price at which bonds can be bought back may be a fixed call price regardless of the call date, but in some cases the call price may change over time. So under a typical call schedule, the call price tends to decline and move towards par value over time. Continuing with bonds with embedded provisions, now we're going to look at puttable bonds. And a puttable bond provides the bondholder with the right, but not the obligation, to sell back or to put back their bonds to the issuer prior to the maturity date at a pre-specified price referred to as the put price. Bondholders might want to exercise this right if market interest rates rise, and they can earn a higher rate by buying another bond that reflects the interest rate increase. In contrast to the call provision, the put provision is a right of the bondholder and not the issuer. Okay, so just remember, callable bonds, call back, puttable bonds, put back, okay? So callable bonds is a right but not an obligation to the issuer. Puttable bonds is a right but not an obligation to the bondholder or the investor, okay? The inclusion of the put provision is a benefit to the bondholder and serves as a disadvantage to the issuer. Consequently, the coupon rate on a puttable bond would generally be lower. Puttable bonds typically do not start providing bondholders with put provisions until after a few years after issuance. And when a bondholder exercises the put provision, the pre-specified put price at which the bonds are sold back to the issuer is typically the bond's par value. So now we're moving on to convertible bonds. And with convertible bonds, a conversion provision gives the bondholders the right, but not the obligation, to exchange the bonds for shares of the issuing company's stock prior to the bond's maturity date. Bonds that contain a conversion provision are referred to as convertible bonds. So a convertible bond is a hybrid security. A hybrid security has characteristics of and relationships with both equity and debt securities. A convertible bond is a bond issued by a company that offers the bondholder the right to convert the bond into a pre-specified number of common shares of the issuing company at some point prior to the bond's maturity date. Convertible bonds are debt securities prior to conversion, but the fact that they can be converted to common shares make their value somewhat dependent on the price of the common shares. Because the conversion feature is a benefit to bondholders, convertible bonds typically offer a coupon rate that is lower than the coupon rate on a similar bond without conversion features. So, and don't forget that convertible bonds are discussed further in the Securities chapter, which is the next chapter after this one. So a quick little practice question from the learning ecosystem at the moderate level. Which of the following provisions in a debt security is a right of the issuer? A, put, B, call, or C, conversion? And the correct answer is B. The call provision provides bond issuers with the right to buy back the bonds prior to maturity at a pre-specified date. A put provision provides the bondholders with the right to sell their bonds to the issuer prior to maturity at a pre-specified price, and a conversion provision provides the bondholders, again, with the right to convert the bonds into a pre-specified number of common shares of the issuing company. Moving on now to Learning Outcome Statement F, which is describe securitization and asset-backed securities. So securitization refers to the creation and issuance of new debt securities called asset-backed securities that are backed by a pool of other debt securities. The most common type of asset-backed security is backed by a pool of mortgages, sometimes referred to as mortgage-backed securities. Mortgage-backed securities have the advantage that default losses and early repayments are much more predictable for a diversified portfolio of mortgages than for individual mortgages, which makes them less risky than individual mortgages. Mortgage-backed securities are based on a pool of underlying residential mortgage loans, home loans repaid through monthly payments, or on a pool of underlying commercial mortgage loans. To create mortgage-backed securities, a financial intermediary bundles a pool of mortgage loans from lenders and subsequently issues debt securities against the pool of mortgages. Securitization improves liquidity, that's an important point, improving liquidity in the underlying asset markets because it allows investors to indirectly buy assets that they otherwise would not or could not buy directly. Because the financial risks associated with security pools are more predictable than the risks of the individual assets, asset-backed securities are easier to price and therefore easier to sell when investors need to raise cash. These characteristics make the market for asset-backed securities more liquid than the market for underlying assets. So asset-backed securities are similar to mortgage-backed securities, except that the types of loans underlying asset-backed securities are debt obligations such as credit card receivables, auto loans, and corporate bonds. In some cases, mortgage-backed securities and asset-backed securities can be repackaged into more complex vehicles. Okay, so investors who buy asset-backed securities receive a portion of the pooled monthly loan payments. Okay, so they receive monthly payments, and it's a portion of the pool. So unlike typical debt securities that offer coupon payments on quarterly, semi-annual, or annual basis, and a single principal payment at the maturity date, most asset-backed securities offer monthly payments that include both an interest component and a principal component. So that's a very important point to understand, is that with the asset-backed securities, monthly payments that include both an interest component and a principal component. So a quick question from the learning ecosystem. This was classified as a difficult question. An implication of the liquidity of asset-backed securities relative to the underlying asset is that A, investors accept a lower return for asset-backed securities, B, asset-backed securities are more difficult to price and sell, or C, investors require a higher return for asset-backed securities. So the correct answer is A, an implication of liquidity. There's greater liquidity with asset-backed securities, so investors will accept a lower return for asset-backed securities. Market for asset-backed securities is more liquid than the market for the underlying assets. Investors value liquidity. They may pay more for asset-backed securities than for individual underlying assets. Since they pay more, they are effectively accepting a lower return for these assets. And just remember that most asset-backed securities make payments to investors on a monthly basis and include both an interest component and a principal component. So a quick summary of bonds with embedded provisions. So some of the embedded provisions: number one, callable bonds, and that's a right of the issuer. Okay. Puttable bonds is a right of the bondholder. Convertible bonds is also a right of the bondholder. Inflation-linked bonds, recall, the important thing to understand, it's the par value, not the coupon rate of the bond, is adjusted at each payment date to reflect changes in inflation. So obviously that coupon payment is going to change. The dollar amount is going to change, not the rate, but the par value is changing. So what is unchanged? The coupon rate is unchanged, but the dollar value of the payment is going to change because the par value is changing. Okay, so that's important to understand. And then we looked at securitization with regards to asset-backed securities, which improves liquidity. So if it improves liquidity, investors are going to pay a higher price, so they're willing to accept a lower return, okay? Learning outcome statement G is define current yield. So a bond's current yield is calculated as the annual coupon payment, that's dollars, divided by the current market price, which is also in dollars. So again, current yield, annual coupon divided by the current market price. A bond's current yield provides bondholders with an estimate of the annualized return from coupon income only, without concern for the effect of any capital gain or loss resulting from changes in the bond's value over time. Later on, we're going to look at how we calculate the value of the bond and how we can see that will change. Increase interest rates, we're going to decrease the bond's price. If interest rates go down, the bond price is going to go up, okay? Nevertheless, when we're talking about current yield, the important thing is to understand it's the annual coupon divided by the current market price. And the current yield should not be confused with the discount rate used to calculate the value of the bond. Again, we're going to look at how to calculate the value of the bond later on. Not required to do the calculations, but you need to understand how we calculate the price based on the discount rate, which is the market rate, and that's not to be confused with the current yield, which is the annual coupon rate divided by the current market price. Learning outcome statement H is describe the discounted cash flow approach to valuing debt securities. So the first thing that we looked at, the zero coupon bonds, it was really easy to calculate the value. It was just the present value calculation of the par value divided by 1 plus the required rate of interest to the power of n. And so we looked at that, the example from the text on the 20-year zero coupon. But now we're going to look at a fixed rate coupon bond. And so for a fixed rate coupon bond, the timing and promised amount of the interest payments and final principal are known. Thus, the value of a fixed rate bond can be expressed as the formula presented on the slide. So the valuation for a fixed rate bond is just the present value of all the future cash flows. That's it. And again, that's why we learn present value calculations in the quantitative concepts, okay? So the example in the text is looking at a 3-year bond, $1,000 face value, 6% coupon, semi-annual payments discounted at 7%. That's the discount rate, the required market rate, okay? So let's just, now you're not required to do the calculations, but again, I think that you're going to see that this is really fairly easy to understand by working your way through the calculation. So let's just bring up the calculator here and work our way through it so that we understand all these figures. So first of all, it's $1,000 face value, 6% coupon. Remember, that coupon rate doesn't change and it's based on the face value. So it's $1,000 times 6%, 0.06. We get a $60 coupon payment, but it's semi-annual, so we're going to divide by 2. We can see that each coupon payment is $30. 3-year bond semi-annually, there's going to be 6 coupon payments, and we can see that 1, 2, 3, 4, 5, and then here's the 6th payment. Remember, this says $1,030 because the bond is maturing, so it's the face value $1,000 plus the $30 coupon payment. That's the 6th payment. And all we're going to do is we're going to discount, we're discounting semi-annually, so you can see the 7% is 3.5% every 6 months. So future value for the first payment is $30 divided by 1 plus R, 1.035%, because it's 6 months, to the power of 1, okay? So you can see the valuation, and there just is just some nomenclature. They're using V naught now. That's present value. The valuation is just the present value of all it's the sum of all of the present value of all the future cash flows, okay? Again, I can show you that this can be calculated using the financial calculator. You don't need to know it. It's a nice to know, not need to know. How would you do it? You would check second PY. So the periods per year is 2. That's semi-annually. Okay, so that's set correctly. And therefore, N in this case is 6 because it's a 3-year bond semi-annually, so N equals 6. So we could also do 3, second, and n, number of years times the periods per year, n equals 6, okay? Now important, when we're calculating the price of a bond, we're using the market rate. We're discounting it at the market rate. So that's 7 is the IY, interest rate per year. The payment is $30 per payment. That's a positive. And we're going to get $1,000 back when it matures. That's the face value or future value or par value. And we can compute the present value, which is the price. You can see it comes up as a negative because one sign has to be negative on the present value and one sign has to be positive. I put in the future value and the payment is positive. So we can see the present value, 973.36. So quite easy to do the calculation for a bond using the time value of money functionality on a financial calculator. But if you wanted to do the algebra, the valuation for a bond is simply the sum of the present value of all the future cash flows. So present value coupon 1, present value coupon 2, present value coupon 3, plus present value coupon 4, plus present value coupon 5, plus the present value of not only the 6th coupon, but also getting the principal back of 1,000, and we get the price of 973.36. And we can see here one thing, because the discount rate is higher than the coupon rate, the present value is less than the face value, and we can say that this bond is trading at a discount to par. It's trading at less than $1,000 because what's happening, it's paying a 6% coupon, but interest rates have gone up. So as interest rates have gone up, the price has gone down. It's selling at a discount, so we can get that yield up to 7%, yield to maturity at 7%, okay? So now we're moving on to learning outcome statement I, which is describe a bond's yield to maturity, okay? So the discount rate that equates the present value of the bond's promised cash flows to its market price is the bond's yield to maturity or yield, okay? So we can see in the previous slide, we calculated using discounted cash flow, we calculated the price of the bond by summing up the present value of all the future cash flows, and we used a discount rate which was equal to the market rate of interest. So what this slide is saying down here is that the price, again, is the is the sum of the present value of all the future cash flows, but it says here the discount rate or interest rate is the required yield to maturity, okay? And so if we know the price of a fixed rate bond or a zero coupon, we can then calculate by solving for I and Y what that required yield to maturity is, okay? So many investors use a bond's yield to maturity to approximate the annualized return from buying the bond at the current market price and holding it until maturity, assuming that all the promised payments are made on time and in full. So when the bond's payments are known, as in the case of a fixed rate bond and zero coupon, the yield to maturity can be inferred using the current market price. So it's important to understand, as we said, the inverse relationship between yield to maturity and bond price. If you decrease the yield to maturity, you're going to increase the bond price, okay? Or bond prices go down, it's going to increase the yield to maturity. And a little table here, if the yield to maturity is greater than the coupon rate, the face value is greater than the present value of the bond. So if you just put in, a hypothetical example, face value is 1,000, and it's greater than the present value of the bond, say put in 900, you can see that the bond is trading at a discount. If the yield to maturity equals the coupon rate, then the face value is going to equal the present value of the bond. That's just a function of the math. That's saying that, we're using the same discount rate here as the coupon rate, the valuation is going to equal par if you work through the math. And if the yield to maturity is less than the coupon rate, so just change that, $1,000, the face value of the bond is less than the present value of the bond, so face value again at 1,000, make the present value of the bond higher, say 1,100, you can see that bond is trading at a premium, okay? So again, as bond prices fall, the yield to maturities increase, and as bond prices rise, the yield to maturity decreases. Learning outcome statement K is defined yield curve. So I just wanted to start here in the learning ecosystem and the text in terms of the lesson. And you can see that the exhibit 2 is showing the U.S. Treasury yield curve from 2014, okay? So, and then just reading quickly from the text, you can see when investors try to determine the appropriate discount rate, yield to maturity, or required rate of return for a particular bond, they often begin by looking at the yields to maturity offered by the government bonds, okay? So the term, and then they're going to add on to it some type of spread. If they're looking at a corporate bond, there's going to be a credit spread. Corporate bonds are more risky than the government bonds. So what is the starting point? The starting point is always with the government bonds and the yield curve. Okay, so the term structure of interest rates, often referred to simply as the term structure, show how interest rates on government bonds vary with maturity. The term structure is often presented in a graphical form referred to as the yield curve, and the yield curve graphs the yield to maturity of government. The y-axis is the yield and the x-axis is time. Okay, and the reason why I started with this, you can see it's based on data from the U.S. Department of Treasury, treasury.gov, and you can see back here on the 30-year bond, it's somewhere between 3 and 4%. Okay. On my slide here, though, I've just done a little bit of an update. And you can see here I have the yield curve. It's the U.S. Treasury yield curve. And this is coming from the JP Morgan Guide to the Markets. Again, that's a free publication that you can find if you just Google search JP Morgan's Guide to the Markets. And this is as of September 30th, 2018. So just a couple of things here. You can see that the 30-year rate on a U.S. Treasury as at September 30th was 3.19%. And here's the yield curve, okay, as at September 30th, 2018 in blue. And what they're doing here is they're comparing it against the yield curve from 2013, December 31st, approximately 5 years ago. And you can see that, up to the 10-year rates are fairly similar right now, but the short-term rates have very much increased over the last 5 years. So that what that's meaning is that if you look at the 3-year rate on the yield curve as at September 30th, 2018, the rate was 2.88%. But that rate 5 years ago, approximately 5 years ago, was much lower, 0.878%. So as we know, rates have been increasing a little bit over the last couple of years. Okay, so this is just updated U.S. Treasury yield curve from JP Morgan's Guide to the Markets. You can see the blue curve is the curve as at September 30th, 2018, and it shows you here that again the concept that for the shorter maturities, 1 year, 2 year, 3 year, the rates are lower than as you go out on the yield curve, as you might expect, because the longer time to maturity is increasing different risks and opportunity costs. This slide is just a quick summary of some of the concepts that we looked at with regards to bond valuation. The first thing that we looked at was current yield. A bond's current yield is calculated as the annual coupon payment divided by the current market price. Then we looked at price estimated by using the discounted cash flow. The value price of a typical debt security is usually estimated by using a discounted cash flow approach. The valuation or price equals the sum of the present value of all the future cash flows. Okay. Moving on to yield to maturity. The yield to maturity is the discount rate that equates the present value or price of a bond's promised cash flows to its market price. Okay. And finally, the term structure of interest rates, the yield curve. The term structure of interest rates depicts the relationship between government bond yields and maturities and is often presented in a graphical form as the yield curve. Now moving on to learning outcome statement L, which is explain risks of investing in debt securities. So investing in debt securities is generally considered less risky than investing in equity securities, but bondholders still face a number of risks. The risks that we're going to look at over the next few slides are credit risk, interest rate risk, inflation risk, liquidity risk, reinvestment risk, and call risk. Okay, so starting with credit risk, sometimes referred to as default risk, is the risk of loss resulting from the borrower or bond issuer failing to make full and timely payments on interest and or the principal. So continuing with credit risk, investors may be able to assess the credit risk of a bond by reviewing its credit rating. independent credit ratings such as Standard & Poor's, Moody's Investor Services, and Fitch Ratings assess the credit quality of particular bonds and assign them ratings based on the creditworthiness of the issuer. Bonds are classified based on credit risk as investment-grade bonds or non-investment-grade bonds. So that's the important thing to understand first. The two broad categories are investment-grade and non-investment-grade, okay? The term investment-grade bond comes from the fact that regulators often specify that certain investors, such as insurance companies and pension funds, must restrict their investments to or largely hold bonds with a high degree of creditworthiness, low risk of default. Non-investment-grade bonds are commonly referred to as high-yield or junk bonds. They are called junk bonds because they are less creditworthy, they offer higher expected returns, but also higher risk. Although both individual and institutional investors tend to own investment-grade bonds, investors with a willingness to take on greater risk in exchange for higher expected returns dominate the high-yield bond market, okay? So credit ratings agencies assign a bond rating at the time of issue, but they also review the rating and may change a bond credit rating over time depending on the issuer's perceived credit worthiness. So an improvement in credit rating is referred to as an upgrade, and a reduction in credit rating is referred to as a downgrade. Now note that on the slide we're looking in terms of the investment grade. Don't forget there's Standard & Poor's, there's Moody's, and the Fitch. You have to be somewhat familiar. The first thing to note is that if you look at Standard & Poor's and Fitch, it's almost basically the same thing, so it's not too difficult to understand. But you can see with Moody's, they're using just a different nomenclature with regards to the investment grade Baa1 to Baa3. So, so a couple of things to understand. Number one, difference between investment grade and non-investment grade. Number two, to understand a little bit of the nomenclature. Number three, you can see that in the text, this is just a summary of the much more expanded categories, which I'll just show you here in a second. So you can see this is Exhibit 3 from the text. Standard & Poor's, Moody's, and Fitch. Standard & Poor's and Fitch are fairly similar with regards to their ratings. You can see it's almost identical, but down here there's a little bit missing. It's a little bit different when you get into the non-investment grade down here. But up here you can see AAA, AAA, AA+, that's the same. Nomenclature a little bit different for Moody's, but the most important thing to understand is the cutoff between the investment grade and the non-investment grade. So that's the very important thing that can be tested on. So you can see here Standard & Poor's, the lowest investment grade is BBB-. For Moody's, Baa3, and for Fitch, again, the BBB-. So if you move down to BB+, that's considered to be non-investment grade or high-yield junk bonds. So this is just a quick example of a practice question from the learning ecosystem, and again, it's classified to be an expert question. And so the assignment of BB and BBB ratings by an independent rating agency implies which type of credit risk classification respectively. So A, junk bond and high yield, or B, high yield and investment grade, or C, investment grade and non-investment grade. Okay, so you can see the assignment of BB and BBB ratings by independent rating agency implies which type of credit rating. The correct answer is B, high yield for the BB and investment grade for the BBB. So bonds are classified based on credit risk as investment grade or non-investment grade. The latter are also referred to as high yield or junk bonds. Investment grades are bond. So here you can see I've just cut and paste from the text. You can see that the lowest level for investment grade, BBB-. So it's asking here the assignment of BB, that's here. BB is here, which is non-investment grade. And BBB, you can see here, is right here. It's investment grade. And don't forget that non-investment grade is also called high yield or junk. So we want to be careful with a little bit of the terminology. But this question, expert, but not too difficult. Again, you don't need to memorize all these different categories. The main thing is the difference between investment grade and non-investment grade high yield or bond. So BB, non-investment grade high yield, BBB is an investment grade. So not too difficult. Double B being junk bond, yeah, that is still right for A, but triple B being high yield, no. Triple B is investment, so that's why that one is wrong. Part of it was right, but part of it was wrong. And if we look here, double B being investment grade, no. Double B is not investment grade, and triple B being a non-investment grade, no, they've got it backwards. So if that question was flipped, you could see, if they put non-investment grade, investment grade, that would also be right. So just be careful, a little bit of the terminology. Probably expect to see maybe a question like this on the test, and the things you need to understand, difference between investment grade, non-investment grade. Non-investment grade, the term is high yield or junk. It's interchangeable, okay? A little bit tricky, but not impossible. So moving on now to interest rate risk. Interest rate risk is the risk that interest rates will change. Specifically, it refers to the risk associated with decreases in bond prices resulting from increases in interest rates. This risk is particularly important for fixed rate bonds and zero coupon bonds. Bond prices and interest rates are inversely related. That is, bond prices increase as interest rates decrease, and bond prices decrease as interest rates increase. And we saw in the previous examples, prices of zero coupon and fixed rate bonds can decline significantly in an environment of rising interest rates. However, because coupon rates on floating rate bonds are reset to current market interest rates at each payment date, floating rate bonds exhibit less interest rate risk with respect to rising interest rates. But a floating rate bond may exhibit interest rate risk in an environment of declining interest rates because bondholders receive less coupon income when the bond's coupon rate is reset to a lower rate. So we're moving on now to inflation risk, okay? So nearly all debt securities expose investors to inflation risk because the promised interest payments and final principal payment from most debt securities are nominal amounts that do not change with inflation. Unfortunately, as inflation makes goods and services more expensive over time, the purchasing power of the coupon payments and the final principal payment declines. Now, we looked at a couple of things. Floating rate bonds partially protect against inflation because the coupon rate adjusts. So remember, that is a floating rate bond. The coupon rate does adjust. That was a LIBOR base plus a fixed spread, okay? So as interest rates change, floating rate bonds, the coupon rate does adjust. That was in contrast to most inflation-linked bonds where the par value, not the coupon rate change of the bond, is adjusted at each payment date. So if there's inflation, the par value goes up, that increased par value times that fixed coupon rate, the coupon payment in terms of dollars is going to change, but not the rate. So that's the important thing to understand. And with these floating rate bonds, they partially protect against inflation because the coupon rate adjusts, but the par value does not adjust, okay? So there's a loss of purchasing power against the principal payment. Investors who are concerned about inflation and want protection against it may prefer to invest in the inflation-linked bonds where there is the adjustment to the principal par value for inflation. Because the coupon payment is based on the par value, the coupon payment changes with inflation, okay? So some of the other risks of investing in debt securities, liquidity risk is being unable to sell a bond prior to the maturity date without having to accept a significant discount to the market value. So anytime there's low liquidity in any security, that is liquidity risk because it creates a bigger spread between the bid and offer or the bid and ask, okay? So same thing with bonds. Liquidity risk is being unable to sell the bond prior to the maturity date without having to accept a big discount to the market value because there's low liquidity. Reinvestment risk is in a period of falling interest rates, the coupon payments received during the life of the bond and or the principal payment received from a bond that is called early must be reinvested at a lower interest rate than the bond's original coupon rate. So in reinvestment risk, I'm getting certain cash flows through coupons, but interest rates are going down, so I have to reinvest those at a lower rate. And finally, on this slide, call risk or prepayment risk is when the issuer will buy back or call the bond issue prior to maturity through the exercise of the call provision. And of course, that risk would only apply to bonds with a call provision on them, callable bonds. So some of the other risks of investing in debt securities: liquidity risk is being unable to sell a bond prior to the maturity date without having to accept a significant discount to the market value. So anytime there's low liquidity in any security, that is liquidity risk, because it creates a bigger spread between the bid and offer, or the bid and ask. Okay. So same thing with bonds. Liquidity risk is being unable to sell the bond prior to the maturity date without having to accept a big discount to the market value, because there's low liquidity. Reinvestment risk is in a period of falling interest rates, the coupon payments received during the life of the bond and or the principal payment received from a bond that is called early must be reinvested at a lower interest rate than the bond's original coupon rate. So in reinvestment risk, I'm getting certain cash flows through coupons, but interest rates are going down, so I have to reinvest those at a lower rate. And finally, on this slide, call risk or prepayment risk is when the issuer will buy back or call the bond issue prior to maturity through the exercise of the call provision. And of course, that risk would only apply to bonds with a call provision on them, callable bonds. So now we're down to the final learning outcome statement M, which is define a credit spread. And basically the difference between a risky bond's yield to maturity and the yield to maturity on a government bond with the same maturity as the risky bond's credit spread. So you can see the yield on the risky bond minus the yield on the government bond equals the credit spread. Higher risk bonds such as junk bonds trade at wider credit spreads because of their higher default risk, and a bond perceived to have an experienced improvement in credit quality will see its price rise and its yield fall, likely resulting in a narrower credit spread relative to a comparable government bond. So just finishing up with this concept of the credit spread, I'm just showing you here the example from the text. It was looking at Caterpillar, okay? So Caterpillar has a bond outstanding. It's still outstanding because the maturity date is the 27th of May, 2041. And the coupon rate is 5.2%. That is fixed. It does not change. So this is looking back in 2012. The bond was trading at a price of $1,185.32, representing a yield to maturity of 4.1%. So you can see coupon rate is 5.2%, but yields in the market have gone down. So as yields have gone down, the price has gone up. Okay, so this bond is trading at a premium. That's interesting to note. And so at that time, though, it says that the bond had approximately 29 years left to maturity. And on that same date, the 30-year Treasury bond was yielding 3.22%. So the way that we calculate the bond's credit spread is the yield to maturity on the bond minus the U.S. Treasury yield, 4.1% minus 3.22% gives us 0.88%, or as I mentioned, 88 basis points, okay? 100 basis points equals 1%. So 0.88% equals 88 basis points. So the extra yield or credit spread being offered by the Caterpillar bond serves as compensation to the investor for taking a higher risk relative to the Treasury bond. So again, I just wanted to show you here. Here is the U.S. Treasury yield curve, and it's showing for 2018 and 2013, which is a little bit close to the example in the text, but it's saying here that, in 2012, the 30-year Treasury was yielding 3.22%, okay? So you can see even between 2012 and 2013, the rates have already started to go up a little bit. So here we are, 3.22% on the 30-year Treasury, and the Caterpillar bond was trading at a yield to maturity of 4.1%. So the, which is a higher yield to maturity. And so that's the difference. That's the credit spread. And so again, sometimes that is shown graphically as the U.S. Treasury yield curve. And then you would look at, a categorization for investment grade or different categories is going to be higher than the U.S. Treasury yield curve. This is kind of the base rate. And then, rates for corporate, could be different government bonds, municipal or provincial, are going to be a little bit more risky than the sovereign bond, the bonds issued by the central government. Moving up to corporates, as we increase the riskiness of the bonds, we're going to increase the spread from that base rate, okay? And that's the last slide for this topic. And that's the conclusion for this video regarding Module 4, Investment Instruments, Chapter 9, Debt Securities for the CFA Institute Investment Foundations program. Thank you.